Hi, I'm Louis Foxwell, a research analyst here at Horan Capital Management. Welcome to our 2018 third quarter market commentary video. In our last quarterly video, John stated that the economic tensions with China would be a major focus of the third quarter. He was correct in his assertion, as U.S.-Chinese relations dominated coverage in the financial media. Tariff increases and other outcomes of the trade war were front and center throughout the quarter. However, despite these trade tensions, the U.S. stock market remained resilient. The broad market climbed higher again during the quarter as earnings rose and general economic sentiment remained positive. U.S. stocks, as measured by the S&P 500 index, were up 7.71% during the quarter, their best quarterly performance so far this year. Year to date, this index is up 10.56%. Now, small cap stocks, as measured by the Russell 2000 index, were up 3.57% during the quarter, and international stocks, as measured by the MSCI EAFE index, were only up 1.42%. Bonds, on the other hand, as measured by the Bloomberg Barclays U.S. Aggregate Bond Index, have returned a negative 1.6% so far this year, and they're roughly even during the third quarter. All in all, large caps performed the best of these four asset classes during the quarter. The Federal Reserve raised the Fed funds rate at the end of the quarter another 25 basis points to 2.25%. This was the third rate hike of the year, as the Fed cited high economic growth and a healthy economy which does not want to overheat. Now, investors are generally flinch at a Fed-driven interest rate tightening cycle, because as a rule of thumb, when interest rates rise, valuations come down because the opportunity cost of investing in assets like stocks and bonds becomes higher. However, despite these raises, U.S. Treasury rates remain historically low. You may have heard about a flattening yield curve during the quarter. This occurs when short-term rates and long-term rates converge towards each other. Interest rates moved upwards during the quarter on all ends of the yield curve, but particularly on the shorter end. The spread between the 2-year and the 30-year Treasury yield narrowed from 46 basis points to 40 basis points. When the yield curve flattens like this, it is generally an indication of a slowing economy, but other economic metrics say otherwise in this current environment. The unemployment rate, for example, remains unchanged at a 17-year low of 3.9% despite a tightening labor market. Discretionary spending continues to rise, volatility remains low, and inflation data suggests that there still might be some slack left in the economy. All of these economic indicators are important to have in the back of your mind, but remember that we are focused on individual stocks in the market. More specifically, we're focused on high-quality businesses selling at a discount to their intrinsic values. As we enter the last quarter of the year, we will keep a watchful eye on opportunities where share prices are punished for non-fundamental reasons. For example, earnings season. Sometimes, as individual companies disappoint on earnings or guidance, we are given the opportunity to purchase shares of a high-quality business at a good price. Another example is window dressing, which is when fund managers sell underperforming stocks at year-end to make their portfolios appear more attractive. This can lead to capitulation and unwarranted negative movements in the prices of high-quality businesses. In addition to these opportunities, we also look for potential headwinds or warning signs in businesses that we own or are considering to purchase. So in short, we're continuously evaluating potential risks and opportunity in any market environment. Thank you again for watching this video. Matt Rocksher will conclude this commentary with some closing remarks.
Thanks, Louis. As Lou mentioned in his commentary, there are definitely mixed signals coming from some of the economic indicators, and we understand that uncertainty can cause investors to be skittish. Many of you have heard us say over and over again, stay focused on your long-term goals. Avoid the day-to-day and week-to-week noise that's out there. As your advisor, we will always act in your best interest, no matter what that noise. So I'll take this opportunity to remind you, should you have any questions or concerns, please don't hesitate to contact us. We look forward to hearing from you. Also, don't forget to review the quarterly portfolio activity, which is posted on our website, or you can navigate there using the link in the email. Thanks for watching. Look forward to seeing you next quarter.